Most people hand over thousands of dollars every year to the government and have no idea if the number is even correct. Not because they're careless, because nobody ever explained the system properly. Not in school, not at work, not anywhere. That ends right now. Picture this. Two coworkers, same company, same city. Sarah earns $45,000 a year. Marcus earns $95,000. One day, Marcus gets a promotion, a raise that pushes him to $100,000. He goes home that night convinced he just made a terrible financial mistake. Why? Because someone told him the extra money would push him into a higher tax bracket. And in that higher bracket, he'd lose more than he gained. He almost turned down the raise. He was completely wrong. But the terrifying part? So are millions of people just like him. Here is the number that should stop you cold. According to a 2023 survey by the Tax Foundation, 52% of Americans don't understand how tax brackets actually work. In the UK, that number climbs closer to 60%. In Canada and Australia, financial literacy surveys tell the same story. More than half the working population in the wealthiest countries on Earth is operating on a myth. So what is actually happening inside those brackets? And why does this misunderstanding cost ordinary people real money, real peace of mind, and real financial decisions every single year? Start at the very beginning. Governments need money. Roads, schools, hospitals, emergency services. That money comes from taxes. Specifically, income taxes. A portion of what people earn goes back to the state. The question has never been whether to tax. The question has always been how much and from whom. The United States introduced the modern federal income tax in 1913 through the 16th Amendment. The UK has had income tax since 1842. Canada formalized its system in 1917. Australia followed in 1915. These systems weren't built overnight. They were argued over, reformed, collapsed, and rebuilt across more than a century. And every single one of them uses the same core structure, a progressive tax system. Progressive doesn't mean political. It means the rate increases as income increases. Earn less, pay a lower percentage. Earn more, pay a higher percentage. Simple in theory, completely misunderstood in practice.
Here's where the myth lives. Most people believe that if they earn more money and cross into a higher bracket, their entire income gets taxed at that higher rate. All of it. Every dollar they earned that year suddenly taxed at 35% or 40% instead of 22%. That belief is wrong. Entirely, provably, mathematically wrong. And it has caused people to turn down raises, avoid freelance income, refuse overtime shifts, and leave money sitting uncollected because they were afraid of losing it to taxes. The actual system works like stairs. In the United States, for 2024, the federal tax brackets for a single filer look like this. The first $11,600 of income is taxed at 10%. Every dollar earned between $11,601 and $47,150 is taxed at 12%. Between $47,151 and $100,525, the rate is 22%. From $100,526 to $191,950, it's 24%. The brackets continue upward from there, 32%, 35%, and finally 37% for income above $609,350. Notice what's happening. Each bracket only applies to the money earned within that range. Go back to Marcus. He earns $100,000. He does not pay 22% on his entire $100,000. He pays 10% on the first $11,600. He pays 12% on the next $35,550. He pays 22% on everything above that up to $100,000. His actual federal tax bill comes to approximately $17,400. That's an effective tax rate, the real percentage of his total income paid in taxes, of about 17.4%. Not 22, not 24, 17.4. This is the number the myth erases completely. Effective tax rate versus marginal tax rate. These two numbers live in the same conversation. They are almost never introduced to each other. The marginal rate is the percentage applied to the last dollar earned, the top bracket someone falls into. The effective rate is the actual average across all income. They're almost never the same number, and the effective rate is always lower. Now ask the real question. Why doesn't anyone explain this? The UK system works on the same principle. For the 2024 to 2025 tax year, there's a personal allowance of $12,570. Income below that threshold is not taxed at all. Between $12,571 and $50,270, the basic rate is 20%. Between $50,271 and $125,140, the higher rate is 40%. Above $125,140, the additional rate is 45%. Again, only the income in each band is taxed at that band's rate. A person earning £60,000 in the UK does not pay 40% on £60,000. They pay 0% on the first £12,570, 20% on the next £37,700, and 40% only on the remaining £9,730.
Their effective rate lands somewhere around 21%, not 40%. Canada uses a federal bracket system starting at 15% on the first $55,867 of taxable income, rising to 20.5%, then 26%, then 29%, and reaching 33% on income above $246,752, with provincial taxes layered on top. Australia applies 0% on income up to $18,200, then 19%, then 32.5% up to $120,000, and higher rates beyond that. Every system, same staircase logic. So here is what actually happens when Marcus accepts his raise to $100,000. He earns more money. He pays a slightly higher rate on only the additional income that crossed into the new bracket. His take-home pay increases. His effective tax rate moves up slightly, not dramatically. He made the right call. The myth almost stopped him. This matters beyond individual paychecks. It shapes entire careers. A 2022 study published in the Journal of Public Economics found that bracket misunderstanding was directly linked to labor supply decisions, meaning real people were working fewer hours, avoiding extra income streams, and making smaller financial moves because of a tax they were miscalculating in their own heads. The researchers estimated the effect was particularly strong among workers earning between $40,000 and $80,000 annually, exactly the middle income range, where an extra few $1,000s makes the biggest real-world difference. These aren't abstract statistics. That's someone not picking up the weekend shift. That's someone passing on freelance work worth $3,000 because they assumed the government would take most of it. That's someone not asking for the raise Marcus almost didn't accept. There's one more concept that lives quietly inside this system, one that, once understood, changes everything. Deductions. Taxable income is not the same as gross income. Before brackets even apply, certain expenses reduce the number the government is working from. In the U.S., the standard deduction for a single filer in 2024 is $14,600. That means the first $14,600 Marcus earns isn't counted as taxable income at all. It's removed before the brackets touch a single dollar. Mortgage interest, retirement contributions, student loan interest, business expenses, these are all mechanisms that lower taxable income legally. They aren't loopholes for the wealthy. They exist in every bracket. The difference is that high earners have accountants explaining them clearly every year without fail. Everyone else is guessing. That's the real system underneath the confusion, not a trap, not a punishment for success. A staircase where each step only costs what it costs, nothing more, and where legal tools exist at every level to lower the total bill. Marcus took the raise. 6 months later, he ran the actual numbers. He kept $82,600 of his $100,000. His effective federal rate was 17.4%. He put $6,000 into a Roth IRA, which lowered his taxable income further. He found out his employer offered a 401k match he had never claimed, free money sitting there untouched for 3 years. He hadn't been losing to the system. He just hadn't been shown how it worked.
The staircase was always there. Most people are just standing at the bottom, afraid to climb it.